I'm Lee, the CEO of Chase Buchanan. With over 30 years of experience in wealth management, we specialise in helping British expatriates manage their financial assets, pensions and investments as they transition to life in Portugal. Relocating or settling in a new country presents a unique set of challenges, particularly when it comes to finances. At Chase Buchanan, we help expatriates who are looking to relocate to Portugal or those who are already living in Portugal. We understand where they are now and where they want to be financially. We then create a clear financial strategy to help you achieve your financial goals for a worry-free life abroad. We help you understand the uncertainties and decisions you face by providing clarity and a clear financial plan. By seeking professional financial advice, you can secure your financial future in your new life, and this is crucial when it comes to UK pensions and other UK assets. If you're planning a permanent move to Portugal, the time to prepare your financial strategy is before you leave the UK. There are some key areas to consider before moving. For example, UK tax advantages like tax-free ISAs and premium bonds don't apply in Portugal. These will be subject to standard Portuguese tax rates. While selling your primary UK residence is generally exempt from capital gains tax in the UK, this is not always the case once you are resident in Portugal, who may tax the gain. It's crucial to understand how your residency status impacts this and plan accordingly. Many UK pensions, especially defined contribution schemes, can be transferred, allowing you to control your pension when overseas. The first Labour budget in October 2024 made changes to QROPS, qualifying recognised overseas pension schemes, but there is still other options to support your new life abroad. An international SIP, a self-invested personal pension, allows you to consolidate multiple UK pensions and actively manage them from a new country whilst the pension fund continues to enjoy the benefits of UK pension legislations. Planning should be made well in advance of your move, as the transfer process can sometimes be lengthy, and at Chase Buchanan we will ensure you stay compliant with both UK and Portuguese regulations. At Chase Buchanan, we will also ensure that your investment strategy aligns with Portuguese tax laws and market conditions. We will work with you to craft a tailored plan that factors in your risk tolerance, goals and currency considerations. Timing your move is also an important factor, as we know the UK tax year runs from April to April, while Portugal aligns with the calendar year. Planning your move at the right time can help minimise cross-border tax complications. By preparing in advance, you save yourself from unexpected tax bills and financial inefficiencies down the road. If you've already made the move to Portugal, it's not too late to address unresolved financial matters. The first area to consider is your tax position to fully optimise your financial future. You may have something called NHR. NHR stands for Non-Habitual Resident in Portugal. It's a special tax regime introduced by the Portuguese government in 2009 to attract foreign investment and skilled professionals to the country. The NHR scheme provides significant tax benefits to individuals who become tax resident in Portugal but were not tax resident in the country for the 5 years prior to their application for NHR status. Under the NHR regime, eligible individuals can benefit from reduced tax rates on foreign income. For example, foreign pensions, dividends and interest may be taxed at lower rates or even exempt from taxation, depending on the type of income and whether there is a double taxation treaty between Portugal and the source country. Flat rate for certain Portuguese income. Individuals working in certain high-value professions, such as those in scientific, artistic or technical fields, may be taxed at a flat rate of 20% income earned in Portugal. Tax exemption on foreign-sourced income. In many cases, foreign-sourced income, for example, dividends, royalties and capital gains, may be exempt from Portuguese taxation. To qualify for NHR status, you must meet certain criteria, such as being a tax resident in Portugal, spending more than 183 days in the country or having a home available to you in Portugal, and applying for the NHR status with the Portuguese tax authorities. The NHR regime is valid for a period of 10 consecutive years, offering substantial benefits to those who are eligible. In 2020, the NHR regime was updated and it subsequently closed to new applicants on the 1st of January 2024. It is vitally important to seek professional financial advice to ensure that you comply with all Portuguese taxation rules, and here at Chase Buchanan, working with our tax partners, we can help support you. If you don't have NHR, all is not lost. The 85-15 tax rule in Portugal refers to a specific tax benefit that applies to certain types of foreign income, particularly pensions. Under this rule, only 15% of your taxable amount is actually taxable. For example, if you had €100,000 tax liability, under the 85-15 tax regime, you would only be liable to 15% of the 100,000, so therefore your tax exposure is only on €15,000 of the 100,000. This means that if a person receiving a pension from abroad becomes a tax resident in Portugal under the NHR regime, only 15% of their foreign pension income will be taxed in Portugal, and the remaining 85% is effectively exempt from Portuguese tax. However, this rule is subject to certain conditions. The rule typically applies to pensions received from foreign sources, but the specific details can depend on the country from which the pension originates and whether there is a double taxation treaty in place between Portugal and that country. The pension must qualify under the NHR programme's criteria for foreign income, and the individual must meet the NHR status requirements. In short, the 85-15 rule makes it more tax efficient for individuals receiving foreign pensions to relocate to Portugal, as it provides partial exemption from taxation on that income. The second area to consider is that many British expatriates find themselves with a dormant pension or investments in the UK that are not aligned with their new financial goals. Let's discuss some of the key areas to focus on. If you've worked for several employers in the UK, you might have left behind multiple pensions, which could now be sitting dormant and underperforming. These pensions might not be benefiting from the most effective investment strategies or competitive fee structures. By consolidating your pensions into a single scheme, such as self-invested personal pension, a SIP, or a qualifying recognised overseas scheme, a QROPS, you can simplify management, potentially lower fees, and gain greater control over your investments. Before proceeding, it's essential to evaluate the UK Labour's government first budget in 2024 and the impact of such a transfer, considering fees, exchange rates, and tax implications in both the UK and Portugal. UK-based tax-free investment vehicles like individual savings accounts, ISAs, lose their tax advantages once you become a Portuguese resident. In fact, continuing to hold these investments may expose you to an unnecessary tax liabilities under Portuguese tax laws. Reassessing your portfolio and moving to tax-efficient investment structures in Portugal can ensure compliance and reduce tax burdens, maximising the returns on your savings. The regulatory landscape for financial advice differs significantly between the UK and Portugal. UK financial advisors are generally restricted from providing advice to residents of Portugal. Therefore, engaging a local advisor who is familiar with both the UK and Portugal financial systems is crucial. Such an advisor can guide you through cross-border compliance issues, including tax obligations, reporting requirements, and investment regulations, helping you avoid costly mistakes. For expatriates, estate planning often takes a backseat amid the complexities of an international move. However, the differences between the UK and Portugal's inheritance laws means that your existing estate plan may no longer be effective or applicable. It's essential to update your will trust, and other estate planning documents to reflect your residency in Portugal and address the potential inheritance tax liabilities in the UK. Failing to do so could lead to unexpected complications for your beneficiaries. As a British expatriate living in Portugal, you are likely earning or spending in euro while maintaining assets in British pounds. Exchange rate fluctuations can significantly impact your finances, particularly for long-term goals like retirement or property purchases. Developing a currency management strategy, such as using forward contracts or multi-currency accounts, can help mitigate the risk and protect your purchasing power over time. Even if you've been in Portugal for a while, it's never too late to take steps that could make a big difference to your financial future. Chatting with an advisor can help get your pensions and investments set up just right for life in Portugal. Why local expertise matters. Whether you're planning your move or already living in Portugal, having a financial advisor who understands both the UK and Portuguese systems is vital. At Chase Buchanan, we understand both the Portuguese system as well as the UK system. Most advisors in the UK are not specialists in Portugal. Having an advisor that lives in Portugal is the best position to help you with your move. Navigating the complexities of cross-border tax and investment regulations can be challenging, especially with the differences in tax treatment between the UK and Portugal. A locally based advisor understands these nuances and can help you optimise your financial strategies, ensuring compliance while maximising tax efficiency. From transitioning UK pensions to adopting investments, their expertise will provide clarity and confidence. Every individual's financial situation is unique, and your goals deserve a bespoke strategy. An advisor with local knowledge will create a financial plan designed specifically for you, aligning with your lifestyle aspirations and long-term objectives. Whether you aim to retire comfortably, purchase a home, or build wealth, their guidance will ensure you're on track to achieve the life you envisioned in Portugal. Financial planning isn't a one-time event. It requires regular reviews and adjustments as your circumstances evolve. A local advisor offers ongoing support, including scheduled reviews, timely updates, and proactive advice. Their proximity ensures that they are readily available to address any questions or changes in your financial needs, keeping your plans on course as life in Portugal unfolds. Key takeaways for moving to Portugal. Planning a move to Portugal is an exciting journey, but it requires careful financial preparation. Here's what you need to consider. Start early. Begin planning your finances well in advance of your move. Early preparation allows for a smoother transition and fewer surprises. Optimise UK pensions and investments. Review your existing UK pensions and investments. Explore options such as transferring or consolidating them. Ensure compliance with Portuguese regulations. Align your financial plans with Portuguese tax laws and regulations to avoid unexpected liabilities and maximise tax efficiency. Work with a qualified advisor. Collaborate with a financial advisor who specialises in cross-border planning and understands both UK and Portuguese tax systems. They help you to avoid common pitfalls, make informed decisions, and capitalise on opportunities unique to your situation. By taking these steps and partnering with the right advisor, you can confidently build a secure and prosperous future in Portugal. If you're planning a move to Portugal or have unresolved financial matters from your UK assets, we would love to help. Contact us at chasebuchanan.com.